Suited criminals. The Cendant deception. In the summer of 1998, Walter Forbes sat in his corner office at Cendant Corporation headquarters in Stamford, Connecticut, looking out at what should have been the pinnacle of his business empire. As chairman and CEO of what appeared to be one of America's most successful hospitality and travel services conglomerates, Forbes commanded a company that owned household names like Days Inn, Ramada, Howard Johnson, Avis Car Rental, and Century 21 Real Estate. Cendant's market capitalization had soared to nearly $14 billion, making it a Wall Street darling and Forbes a celebrated corporate leader. But beneath the gleaming surface of this hospitality giant lay a web of accounting fraud so sophisticated and pervasive that it would ultimately cost investors over $14 billion in market value losses and earn Cendant the dubious distinction of orchestrating one of the largest accounting frauds in American corporate history. The empire that Walter Forbes had built wasn't constructed on innovative business strategies or exceptional customer service. It was built on a foundation of fabricated financial statements, manipulated earnings, and a culture of deception that had been festering for over 3 years. The roots of Cendant's fraudulent operations traced back to the December 1997 merger between CUC International, led by Walter Forbes, and HFS Incorporated, headed by Henry Silverman. This $55 billion merger was supposed to create a travel and membership services powerhouse, combining CUC's membership-based business model with HFS's franchise operations in hotels, car rentals, and real estate. CUC International had built its reputation on providing discount shopping services and travel clubs to consumers, while HFS had established itself as a dominant force in franchise hospitality brands. The merger was hailed by financial analysts as a strategic masterstroke that would leverage the complementary strengths of both companies to dominate the travel services industry. Investment banks Goldman Sachs and Merrill Lynch facilitated the complex transaction, which was structured as a merger of equals, with Forbes serving as chairman and Silverman as president and CEO. The newly formed Cendant Corporation immediately became a component of the S&P 500 index, and institutional investors, including Fidelity, Vanguard, and State Street, poured billions into the stock. What none of these sophisticated investors realized was that CUC International had been systematically inflating its earnings for years, and the merger had simply provided a larger stage for the fraud to continue. The mechanics of Cendant's accounting fraud were breathtaking in their scope and sophistication, involving a coordinated effort by senior executives to manipulate virtually every aspect of the company's financial reporting. At the heart of the scheme was the systematic inflation of revenues through a practice known as revenue smoothing, where executives would artificially boost quarterly earnings to meet Wall Street expectations and maintain the company's stock price momentum. The fraud involved manipulating membership fee revenues by recording payments that hadn't been received, extending the recognition period for membership services beyond acceptable accounting standards, and creating entirely fictitious revenue streams through shell companies and phantom transactions. Chief Financial Officer Cosmo Corigliano and Chief Accounting Officer Ann Pember worked in concert with Forbes to maintain detailed spreadsheets that tracked the cumulative amount of fraudulent earnings adjustments, which they euphemistically referred to as opportunities in internal communications. The fraud extended to expense manipulation, where legitimate business costs were improperly capitalized or shifted between accounting periods to artificially reduce reported expenses and inflate net income. By 1998, the fraudulent adjustments had accumulated to over $500 million in fictitious earnings over a 3-year period, representing approximately 40% of CUC's reported pre-merger profits. The cultural environment at CUC International that enabled such massive fraud was characterized by intense pressure to meet quarterly earnings expectations and a systematic breakdown of internal controls and corporate governance. Walter Forbes had built CUC's business model around aggressive growth targets and had created a compensation structure that heavily incentivized senior executives to meet specific financial benchmarks, regardless of the methods used to achieve them. The company's accounting department operated under what former employees later described as a siege mentality, where questioning unusual accounting practices was discouraged, and loyalty to senior management was prioritized over adherence to generally accepted accounting principles. Forbes had cultivated relationships with board members who rarely challenged management decisions, and the company's external auditor, Ernst & Young, had grown overly comfortable with CUC's aggressive accounting interpretations after years of providing both audit and consulting services. The fraud was facilitated by CUC's complex corporate structure, which included dozens of subsidiaries and joint ventures that made it difficult for auditors and regulators to trace the flow of revenues and expenses. Internal whistleblowers were systematically marginalized or terminated, and the company maintained a policy of restricting access to detailed financial records to a small circle of senior executives who were either complicit in the fraud or intimidated into silence. The unraveling of Cendant's massive fraud began in April 1998, just months after the completion of the CUC-HFS merger, when Henry Silverman's team of financial executives began conducting detailed due diligence on CUC's historical financial statements. Silverman had insisted on a thorough post-merger audit to integrate the two companies' accounting systems, a process that was initially met with resistance from Forbes and his team. The investigation was led by Cendant's new chief financial officer, Kirk Shelton, who had joined from HFS and was not part of the original CUC management team. Shelton's team discovered significant discrepancies in CUC's membership revenue calculations and found evidence of journal entries that appeared to have no legitimate business purpose. The investigators uncovered a pattern of last-minute accounting adjustments that consistently boosted quarterly earnings by precise amounts needed to meet Wall Street consensus estimates, a level of precision that was statistically impossible through normal business operations. When Shelton confronted CUC's former accounting team about these irregularities, several employees broke down and admitted to participating in the fraudulent scheme under direct orders from senior management. The investigation also revealed that CUC had maintained a separate set of internal financial records that showed the company's true financial performance, which was significantly below the results reported to investors and regulators. The immediate aftermath of Cendant's fraud disclosure created one of the most dramatic single-day stock collapses in Wall Street history and triggered a crisis of confidence that reverberated throughout the hospitality and travel services industry. On July 15, 1998, Cendant announced that it would restate its earnings for 1995, 1996, and 1997, reducing previously reported profits by approximately $500 million, and revealing that the company had never been as profitable as investors had believed. The stock price, which had been trading at over $41 per share just days earlier, plummeted to under $10 in a matter of hours, wiping out over $14 billion in market value and devastating the retirement accounts and investment portfolios of millions of Americans. The Securities and Exchange Commission immediately launched an investigation, and the Department of Justice opened a criminal inquiry that would eventually result in multiple indictments and prison sentences for senior executives. Institutional investors, led by the California Public Employees Retirement System and the New York State Common Retirement Fund, filed class action lawsuits seeking billions in damages, while credit rating agencies downgraded Cendant's debt to junk status. The company was forced to draw down its entire credit facility to maintain operations, and several major business partners, including American Express and Citibank, suspended their marketing relationships with Cendant until the full scope of the fraud could be determined. The criminal prosecution of Cendant's executives became a landmark case in the enforcement of federal securities laws and established important precedents for holding senior corporate officers accountable for financial statement fraud. Walter Forbes was indicted on multiple counts of securities fraud, conspiracy, and making false statements to auditors, charges that carried potential sentences of over 20 years in federal prison. The government's case, led by prosecutors from the Southern District of New York, relied heavily on internal documents and testimony from cooperating witnesses who had participated in the fraud but agreed to assist the investigation in exchange for reduced sentences. Forbes maintained his innocence throughout the legal proceedings, claiming that he had relied on his subordinates to ensure the accuracy of financial reports and that he had no knowledge of the specific fraudulent accounting adjustments. However, prosecutors presented evidence showing that Forbes had personally reviewed and approved many of the fraudulent journal entries and had participated in meetings where executives discussed strategies for manipulating earnings to meet Wall Street expectations. Chief Financial Officer Cosmo Carigliano ultimately pleaded guilty to conspiracy and securities fraud charges and was sentenced to 20 months in federal prison, while Chief Accounting Officer Ann Pember received 18 months for her role in implementing the fraudulent accounting schemes. Forbes was eventually convicted on all charges in 2007 and sentenced to 12 years and 7 months in federal prison, one of the longest sentences ever imposed for accounting fraud at that time. The regulatory and legislative response to the Cendant fraud contributed to significant changes in corporate governance standards and auditing practices that would later be formalized in the Sarbanes-Oxley Act of 2002. The Securities and Exchange Commission used the Cendant case to establish new guidelines for auditor independence, requiring accounting firms to limit their consulting relationships with audit clients and mandating more frequent rotation of lead audit partners. The case also highlighted the inadequacy of existing internal control requirements and led to proposals for mandatory management certification of financial statements, a requirement that would become law 4 years later under Sarbanes-Oxley Section 302. Congressional hearings on the Cendant fraud featured testimony from investors who had lost their life savings and retirement funds, creating political pressure for stronger penalties for corporate executives who engaged in financial statement manipulation. The case also prompted the Financial Accounting Standards Board to issue new guidance on revenue recognition practices, particularly for companies with complex membership and service fee structures similar to CUC's business model. Cendant ultimately paid over $3 billion in civil settlements to resolve investor lawsuits, one of the largest securities fraud settlements in history at that time, while Ernst & Young paid an additional $300 million to settle claims related to their audit failures. The long-term consequences of the Cendant fraud extended far beyond the immediate financial losses and criminal prosecutions, fundamentally altering the landscape of corporate America and contributing to a broader crisis of confidence in financial reporting that would culminate in the corporate scandals of the early 2000s. Henry Silverman successfully restructured Cendant after the fraud disclosure, divesting non-core assets and focusing on the company's legitimate franchise operations, ultimately restoring some measure of credibility to the Cendant brands. However, the reputational damage from the fraud continued to impact the company's ability to attract investors and business partners for years after the initial disclosure. The case became a cautionary tale taught in business schools across the country, illustrating how the pressure to meet quarterly earnings expectations could lead otherwise successful executives to compromise their integrity and destroy shareholder value. For Walter Forbes, the man who had once been celebrated as a visionary business leader, the fraud marked the end of a career and reputation that had taken decades to build. The $500 million Cendant fraud demonstrated that no company, regardless of its size or market position, was immune to the corrosive effects of earnings management and accounting manipulation. In an era where corporate executives were increasingly viewed as celebrities and business success was measured primarily by stock price performance, the Cendant scandal served as a stark reminder that sustainable business success could only be built on a foundation of honest financial reporting and ethical leadership. The hospitality conglomerate that Walter Forbes had built on fabricated financial statements ultimately became a symbol of everything wrong with corporate America in the late 1990s. A period when the pursuit of short-term profits had too often taken precedence over long-term value creation and fiduciary responsibility to investors.